Hey everyone, and welcome to the next section of your Bronze Academy. In the first section, we really went through what options are. We defined the different characteristics of options and some of the things that really make them tick. In this section, we're going to be introducing a new concept called volatility, which is really going to change the way that you're able to think about options. It's going to open up the world of options trading to you and really break down for you where the edge lies, the real opportunity for traders when we're looking at the option space. I hope you're excited to go through this section because by the end of it, you're going to have a really clear understanding of what it takes to win as an options trader. So to get started with our discussion on volatility, I'm going to start by introducing an example for you that can really break down how this concept actually works in the stock market. So let's say we were looking at two different stocks. We were looking at Coca-Cola and Tesla. And let's say that we were looking at how these stocks move over a 3-day period. So we have day 1, day 2, and day 3. And we want to see what percentage change happens in each of these stocks. And then we're going to do a little comparison of the two. So let's say for Coca-Cola, right? Coca-Cola, if we think about it, you got really strong fundamentals. It's a company that's been around for a long time. Tons of analysts look at it. We have a pretty good idea of the kind of money that Coca-Cola makes. So on a day-to-day basis, we usually don't see major swings in the stock price. It tends to trend upwards. We might see something like this. Day 1, it goes up 1%. Day 2, it maybe goes down 1%. And on day 3, maybe it goes up 2%. Right? Pretty steady growth. Some down days, some up days, trending towards the upside. And the chart for it would maybe look like this, right? It would go like this, and then it would go like this, and then it would go like this. And we'd see something like that, and it would keep going that way up into the future. But what if we looked at a company like Tesla? What would we see there? Well, from what we understand about Tesla is it moves a lot. There's a lot of movement on a day-to-day basis with Tesla. There could be a 10% move up in one day and a 15% move down the next day. So when we look at Tesla on a day-to-day basis, we may see something like this. Up 7%, up 10%, down 5%. Right? We could see something like that very, very easily. And if we were to graph it out, it would look something like this, right? It would go like this, and then it would go like this, and then it would go like this. So if we look at the two stocks, we can clearly see that Coca-Cola is a lot more stable than Tesla. There's a lot less risk when you are buying a company like Coca-Cola relative to when you are buying a company like Tesla. With that understanding, I have a question for you. If we were to be trading options around these two companies, which one do you think would have more expensive options? If you guessed Tesla, you would be correct. But the reasoning behind why Tesla's options would be more expensive is the real point of going through this example. The reason why the options for Tesla would be more expensive in this situation than the options for Coca-Cola is because there is more risk associated with Tesla. The odds of Tesla moving 5 or 10% a day is much greater than the odds of that happening with a company like Coca-Cola. So if we said that each of these companies were trading at $100 right now, right? Let's say they were both trading at $100. It might make sense for an option that lasted these 3 days to only cost us $3 for Coca-Cola. But it wouldn't make sense for that option to cost us $3 for Tesla. The reason being is that Tesla is a lot more volatile of a stock than Coca-Cola. On a day-to-day movement, the range that Tesla can move within is greater than the range that Coca-Cola is likely to move within by a lot in this case. So we have to remember, right? When we're looking at the option market, there's somebody who's buying it and there's somebody who's selling it. So if this option was $3, why would someone ever sell it? It sounds like a pretty bad trade for the person on the selling side. So what we might actually see is if this was a call option, it might actually be priced at something like $10 to accommodate for the fact that we could see a 10 or 12% move up in this stock in the next 3 days. This brings us full circle to why we really care about volatility. Understanding how these stocks move on a day-to-day basis. It's because volatility is what determines the price of the options that we're trading. And remember, if we're trying to become sophisticated traders, we need to understand how these options are priced. And once we can understand them, and we understand what drives the price in them, we can actually go out into the market and try to find mispriced options. But in order to know what something's worth, we need to understand the concepts that underlie the price. So to be clear, we're going to do a quick summary here. So volatility is really one simple thing. Vol is the size of the moves. That's really all volatility is. It's the size of the moves on a day-to-day basis for a stock or over a given time period. To understand option price, we need to understand volatility. Because the options are actually priced based on the market's outlook on how a stock is going to move in the future. The more a stock is likely to move within the days to expiration of the option, the more pricey that option is likely to be. So remember, if we can sort of back out of it, we want to look at this in depth. But in order to do it, we got to understand this. And in order to understand this, we need to have a really good concept about what it means to look at the size of the moves that happen around a stock. One more characteristic about volatility that we need to really understand just for our introduction here is that volatility is not direction. It's not just about how much up or how much down a stock goes. It's this range. So volatility does not have a directional bias. It's the size of the moves, not the direction of the moves. And before we move on to the next video where we're really going to start digging deep on what volatility is, I need to leave you with one more thought. A common mistake made by most traders is that they'll come into the option space and they'll say things like, I love trading options, but I'm not a volatility trader. I like taking directional bets, but volatility is not something that I really care for. And this is a very big mistake made early on by most traders. And if we can correct that now, we're going to be setting ourselves up for a lot of success. Here's the reality. If you are an options trader, you are a vol trader, whether you like it or not. If you are a vol trader, you are an options trader. They are one in the same thing. Trading options is trading volatility. And how do we know this? Because it's a part of how options are priced. The option price is determined based on the future volatility that the market thinks there will be. So how are we supposed to be options traders without an understanding of volatility or the size of the moves that there are going to be in the future for a stock? Once we can wrap our head around these concepts, we can actually start to really grasp what's going on with the option price. And remember, the best traders understand the numbers and they are all price sensitive. So if we can understand volatility and apply the basic concepts to our understanding of option price, we can really start to set ourselves apart from everyone else. As we dive deep into the bronze course, we're going to be focusing on volatility and structuring volatility trades. So for the time being, we're going to forget about direction and we're going to focus strictly on the concept of volatility itself and actually placing trades around it. But don't worry, down the road in the academy, in your silver education, we're going to be reintroducing the concept of direction and giving you some phenomenal ideas that you'll be able to implement into your trading strategy. But in order for us to start trading direction, we really need to have this concept down. I can't stress it enough. And that's why we're going to be spending the rest of the academy focused on volatility. Thanks a lot, everyone, and I'll see you in the next video where we're going to be breaking down the different types of volatility that you'll actually find when you look out into the option space.